Thanks so much for tuning into this earnings conversation with the management of Sona Comstar. Rohit Nanda, Group CFO, is with us to talk about how the quarter went by, which saw uptick in revenues, maybe saw a little bit of margin pressure, and therefore compared to the Bloomberg estimates or compared to the poll done by BQ, the bottom line number is slightly lower, but their EV contribution keeps on moving up quarter by quarter. And the questions would be around not just what's happening in the quarter, but the outlook ahead. Rohit, great having you. Thanks for joining in. Hope all is well.
Hi, Neeraj. Thanks for having me here.
The pleasure is ours. So, Rohit, put the quarter into perspective. It seemed a quarter of revenue growth. I believe the highest ever revenues in a quarter clocked in by your company. But if not marred, then at least punctuated by also some bit of margin pressure.
Yeah, so Neeraj, revenue, like you said, was the highest ever. So we've seen an 18% revenue growth. If you look at the details of the revenue, EV revenues continue to be very robust. So we had a 68% growth. Within the EV revenue, also even the Indian two-wheeler, three-wheeler market now seems to be picking up. It's gathering pace. So against say 1.5% share of revenue in the last year, it suddenly jumped to now 4% of our revenue. So this market is gaining traction and holds a lot of promise. Our EV order wins, we've had 2 large order wins in this quarter. That was another highlight for us. Margins, like you rightly said, there is pressure because of the material prices, but we feel that the material prices may have peaked out. In terms of the bottom line, if you look at the PAT, I think the real comparison has to be with the adjusted PAT of last year. We had an exceptional income of about 10 crores, which is included in last year's PAT. If you take that out, then we actually had a PAT growth of 5%.
Oh, okay. Well, actually, I don't know our numbers. Okay, you're saying you had because I thought the PAT numbers based on what we've calculated was down at about 75 odd crores versus 104 odd crores. So even if I take out 10 odd crores, it'll still be a lower PAT compared to the last quarter, right?
I was talking about the first quarter of last year. Even in the previous quarter also, we had some one-off incomes.
Okay.
Compared to the last previous quarter, it would be more flattish.
Okay.
But compared to the first quarter of last year, it would be a 5% growth.
Got it. Any chance? I mean, these numbers keep on changing. So without dwelling too much on the minutiae, a couple of questions. Most conversations, and then we'll get to the EV part as well. Most conversations that I had with CEOs or CFOs across industries, they don't see a risk to revenue growth as much, except for consumer companies per se. But B2B doesn't see a risk to revenue growth. They see a risk of margins because of input costs. Now you are telling me that for you, maybe input costs have started to peak or peaked already. Therefore, are your concerns different when I think of the year ahead? And if I were to ask you what could be the risk to the growth, what would that be?
So I think, like I said, I think the metal prices, which are the key imports. So our sense that we are getting from the market information, etc., is that it may have actually peaked out. So that's a positive. The risk to growth would be more macroeconomic, I would say, with what's happening in Europe and China also having slowed down, and US also there are talks of a slowdown. So there may be macro headwinds from that standpoint. We, however, continue to be quite positive because of the new programs, etc., also which are starting this year, because we are not only banking on, we are not purely banking on the underlying growth in the industry per se, but also the fact that we have a lot of our new programs which are kicking in this year. So the growth that we are looking forward to is more coming from the new programs kicking in this year.
Okay, would you want to talk a bit about that? And then I'll come to the revenue and the wallet share of customers, but the new programs that you're talking about?
Yeah, so the way our business is structured is that generally, the product development cycle is longish. So it takes anywhere between 18 to 24 months for us to win a contract. But once that contract is won, and once it is productionized, it continues for long. So the programs that we've won in the last couple of years, some of them are going to be productionized in this year, and that's where I would say the confidence is coming from, that the new programs will start this year, and these include both EV as well as non-EV programs.
Okay, and sorry, by this year you mean FY23. So some of these will get operational in FY23 and start showing the color maybe second half, or in FY24. Would that be a safe presumption?
No, so I was referring to the programs which are starting within FY23.
Within FY23 itself. So therefore, the second half could actually show better growth compared to if I were to annualize FY23 only on the basis of Q1.
Correct. So your assumption is correct. So as we progress in the year, there are new programs which will start supplying to our customers. So other things being equal, it should improve as we go along.
Yeah, I mean, so we've already seen a rapid scale up of revenue from the BEV programs, right? I believe if our numbers are not incorrect, higher by 68%. I mean, and they kind of come up to 29% of overall revenues EVs, and I believe you won some 6 new clients, if I'm not wrong. And I heard you say that even the two-wheeler revenues have grown up to 4%. So tell us, one, about the new wins, and two, are you increasing the wallet share from the existing customers as well, or is this largely on account of newer customers coming in?
Sure. So during this quarter, we've won 6 EV orders, and within these 6 orders, there are 3 program wins which are from legacy automakers, and these programs I refer to because these are fairly large. So the lifetime revenue for these large projects that I'm talking about aggregates to more than 2,500 crores as a lifetime revenue. So these are fairly large wins, and we are very proud of these wins. They will one of these will actually start production and sales within the current financial year, actually more towards the 3rd and 4th quarter, and the other one, the revenues will start in about 2 years. So these are the project wins for this year.
Okay.
But maybe I missed out on part of your question, if you may repeat.
Yeah, no, the other question that I was wanting to understand from you is, are you already increasing the wallet share per customer at an early stage, or is the revenue growth in the EV side largely happening from newer customers getting added, and the mining of the customers is going to happen maybe a few quarters down the line?
Look, wallet share with individual customers, sometimes is hard to calculate. I would say that it's a mix of both, in the sense that there are some programs are new, but the customers are existing. At the same time, there are new customers also and new programs which are kicking in. So it's a mix, but in terms of increase in share of wallet, I would say yes, for the existing customers, overall the share of wallet would also be going up, but it's not something apart from the overall market share, I would say, for us in our products. It's hard for us to calculate, how the overall share of wallet is going up.
Okay. Fair call. So what's the sense on how does the rest of the year look like? So starting first, I understand that some of your key EV products are eligible for PLI incentives. Would that be correct? And would that aid EBITDA margins going ahead?
Sure. So yeah, that assumption is correct. So we have qualified for the PLI scheme which the government had announced and we had applied for. So it should help our margins going forward. However, we have decided to sort of account for these PLI benefits basis actual receipt, which should start happening from the next financial year, actually. So although we will qualify for the benefits from FY23 onwards, but the way the payment from the government side is expected is with a lag of 1 year. So it should start coming to the P&L from the next financial year.
Okay. So in which case, would it be safe to assume that what you've done in Q1 FY23 on the operational metrics front Is that a bit of a base, even if you don't account for the PLI benefits, as you said? Because I did hear you say that the raw material cost might also be peaking. So is this the base of sorts, or could there be further pressure going ahead?
Well, as I said, my sense is that it should be the base, and things should improve in terms of margins as we go along. That's with the premise that the commodity prices seem to have peaked out.
Okay. Yeah, sure. Of course, it's a hypothesis, but okay. I just wanted to hear that from you. So that is part one. Part two, your order book. Again, if my math or if my information is not correct, second best quarter ever for you in terms of business development. So tell us a bit about the nature of the order wins, and tell us how do you expect the rest of the year to be in terms of order flows?
Sure. So you're absolutely right. This was our second best quarter in terms of the order wins, and the large orders in particular that we talk about. One of the order is with a legacy two-wheeler, three-wheeler automaker in India. It's an order to supply EV motors for their EV two and three wheelers, and the other order is on the driveline business side of it, wherein the order is for supplying differential assembly with the final drive gear to a large European automaker. It's a legacy automaker. It's a very prestigious and large order.
Okay, and you expect this momentum to continue into the quarters to come?
Neeraj, I think the order wins typically they can be lumpy. It's hard for us to say, because they generally don't tend to follow any trend. So we have multiple discussions at all points of time, but in terms of maturing of the orders, sometimes you get a lumpy sort of order wins in a quarter, and then there may be quarters wherein the order wins may not necessarily be proportionate or something. So it could be either way, but our overall order book and even the discussion stage pipeline is also very solid. That's all I can say.
Okay. I have one final question, Rohit, and that is, I don't know if it kind of applies to your space or no, but there's a lot of talk about how, one, of course, China plus one, and how West may want to do East, and therefore India fits in, and auto anchors have traditionally been a strong suit of the country. Two, there is a lot of conversation around how, even in Germany, for example, because of the higher gas prices, they are finding it difficult to continue manufacturing of key productions across industries, and therefore even that may actually increase, even if it's on a temporary basis, eastward, and likely to countries like India. Are you sensing that from within your conversations with business leaders in Europe, or not necessarily so?
So, look, this conversation has been on, I think, now for a few years, which is, more like China plus one policy, etc. But look, in our case, our products are more technology oriented. So I would say that irrespective of that itself, we've actually been getting a lot of traction.
Yeah, sure.
If the things are moving in the direction that you pointed out, if that happens or as it unfolds, we will definitely be one of the beneficiaries of it. But our sense is that more sourcing from us, given our order book and what we've done in the recent years, is a lot of this is more technology led and not necessarily, cost efficiency or a low cost sourcing bit of it actually.
Yeah, what I meant was not necessarily just low cost, but also the fact that if there is a temporary issue out there in Europe because of the higher gas prices, wherein the availability itself is a question mark, and if they can't produce, then would they look to move eastwards, even if temporarily so? So that was largely the reason why I asked you. Final question, Rohit. Sorry, you wanted to make a point?
Yeah, so my only point in this case was that if it is going to be a temporary thing, it may not actually work too much in the auto industry, because generally the order approval cycle itself, as I said, is between 18 months or so. But if it is a long-term trend, definitely yes.
Okay. That's thanks for that insight. One final question then. As we saw this quarter as well, even if you could argue that the operational metrics, because of input costs, had a small issue, if you will. The revenue side was rock solid. You reckon this performance can continue and execution of, because the order book is not an issue for you, right? Compared to the annual revenues, it will only, the quantum of revenues that you do would be a factor of the execution that you do. So could execution challenges crop up due to n number of reasons, or you reckon that will not be the case?
Look, last 2-3 years have been challenging, to be honest, for everybody. I mean, we've seen things which probably nobody would have imagined, like a complete lockdown globally, etc., etc. But I would say that given the fact that even during those phases also we managed to execute a large part of our projects. So I think hiccups may be there here and there, but largely we are fairly confident that execution should not be a challenge. There would definitely be challenges, but I think largely, I mean, even in terms of the supply chains, etc., are a bit overstretched, even in terms of capex items also. But still, I don't see execution as a challenge.
But lovely talking to you. Thank you so much for spending the time today and giving us some insights, and all the best for the quarters ahead.
Thank you, Neeraj. Thank you.
The pleasure was ours. And viewers, thanks for tuning into this conversation with Sona Comstar.